Hello, everyone. This is our third session on our synthetic long stock strategy. We're going to go into the strategy details today. Should be some good stuff, so let's dive right into it. As usual, we start with our rules of the road. Basically, no one's offering professional advice or any of that good stuff. In a nutshell, all of this boils down to the fact that we are all grown-ups and we take responsibility for our own trades, whether they work or don't. If you want the legalese down at the bottom, please feel free to read it yourself. But again, remember, we're all big boys and girls here. This is basically what this slide says. Okay, our most important rules. I mention these at every meeting because I really think they're important. Whichever strategy you use, these will make you a better investor. They will make you a better trader. And basically, they're very basic. It's start by paper trading. Experiment on paper before you throw real money at it. And then once you do get to the point where you're comfortable throwing real money at it, start those real investments and those real trades with small positions. Small positions help you get a better feel for how it's going to work once real money's on the table. And it takes out two of the biggest variables. That is, paper money trading doesn't work exactly the same way as real money trading, and there's also a different psychological perspective. Once you got real money on the table, you start looking at things a little bit differently. So if you move into small positions and you're happy with the results, then start moving into full-size positions. And the most important rule, if at any step you stop getting the results that you expect, don't be afraid to back up to the previous step. Whether you're just starting with small positions and immediately things are falling apart, go back to paper trading. Clearly, what that's telling you is something has changed, and it could be the market, it could be you, it could be absolutely anything. So going back to the previous step will help keep your losses small and your and everything going in the way that you want it to. Okay, quick review from our last session. We talked about the difference between posture and sentiment as we use it within this group. And those are really pretty easy, but they're important because just so we're clear as we're discussing things. Posture is our long-term view. That's going out 6 months, 9 months, or even longer. Whereas sentiment is our short-term view, typically looking at 1 to 6 weeks. So when we start out our meetings, a lot of times we talk about our market sentiment, and that's our expectations for the near term. Our posture rarely changes. Our posture is typically looking out for the long period, so the short movements of the market don't affect us too much. And then, of course, we also talked about at our last session how to put on a bullish synthetic position, and we used the TOS platform to do that. And it's really pretty simple. You just go into your trade page, you right-click on the desired strike and the desired month, select buy, collar synthetic combo, or if you're putting on a bearish synthetic, you want to select sell. And that's it. And then that'll come up and it'll tell you the mid price, the natural price, and you can adjust from there. So with that review behind us, let's go ahead and jump into our strategy details. I really like this the method that we use for this. I find the returns are what I feel are appropriate, meaning they're pretty darn good. So what I want to go into now is how do we actually execute the strategy. And so I'm going to start with a ticker, selecting the ticker. The strategy can be used with any stock or ETF, but I prefer to limit myself to a single ticker. And that's personal preference. I don't want to go out and learn 10 or 15 or 100 different companies. I want to stick with one ticker, get comfortable with it. And the one I've selected, because I'm not looking at a whole bunch of different companies, is SPY. And the reason I selected that ticker is it's very well diversified. Obviously, it's made up of 500 different companies. So news from one company or even one industry is not going to have a huge impact on the ticker or on the overall ticker of the SPY. It's that diversification helps mitigate the bigger swings. I've found that the market maker is also very fair. When I'm putting on an order for a long synthetic, or I'm rolling a position, if I want the trade to execute pretty much immediately, if I put a limit order 1 penny below the mid price, I will typically get execution almost immediately. That's pretty darn good. And then if I want to let it sit for a while, I can put it at the mid, or I can even put it higher and let the price come to where I expect it to be. I don't usually do that. Normally, I've made my plan. I know what my expectations are. And so when I go in and execute it, I usually put it in right about a penny below the mid price, so I get a quick execution, and I can go on from there. Another nice thing about the SPY is it's aligned to the SPX, obviously, and the SPX has been in a long-term uptrend. Again, I've said before, this strategy, you have to have a bullish posture. Well, SPX has been bullish for about 85 years. That's a pretty strong directional trade, in my opinion. So I like the fact that it's uptrending. Even when we had bear markets, the bear markets recovered, and we're back in that long-term bullish trend again. So it's very easy to be bullish on SPX, in my opinion. Open interest. That's another thing that's important to me, because as we grow this our group account here, I don't ever want to get to the point where I become the market maker, and that can be easy to do on, the more thinly traded a ticker is, the easier that is to happen. Now, if you look at SPX or SPY rather on for any month, look at the near-term open interest, for the current month and the next month out, you'll typically see thousands of contracts in open interest at each strike price. So there's really no chance that we're going to become the market maker with if we're using the SPY as our investment vehicle, which is important, because again, you don't want to be trading against yourself. So the next thing we want to talk about is, so I know what ticker, I've got the ticker that I'm going to be using. The next question is always, how do I know what strike price I'm going to purchase when I buy a bullish, or when I buy a synthetic position, or I put on a bullish synthetic position? What I do is I typically use an at the money strike. We're going to talk about timeout, or how much distance in just a second. So I'm going to skip that piece until we get to that slide. But for new entries, I'm going to use the at the money strike. If I'm rolling a bullish synthetic, I'll normally pick a strike that's deeper in the money, but I don't already have. And as an inventory of synthetic positions builds up, you may find that instead of strike prices that you don't already have, you're going to be grouping them into, okay, I've only got two synthetic positions at this strike price, or I've only got 3 at that strike price. So, but mainly what I'm looking to do is I'm looking to spread out my positions across multiple strike prices. So when I roll them out, that's what I'm looking for. I'm looking for something that's in the money and a strike price that I don't already have. If I'm putting on a new bearish position, if I'm putting on a new bearish synthetic, which I use for protection during small pullbacks or large pullbacks, what I try to do is I pick a strike price that will allow the trade to be entered for free or at a very low cost. If I get paid to put on the trade, that's great, but I'm really looking just to keep the cost of putting on that protection down to as close to zero as possible. And then selecting an expiration month. This is kind of the key. Now, I mentioned before that I pick a strike price that's at the money. So, and for new positions, I'm picking an expiration month that is about 9 months out in time. Now, you can use that a little bit flexibly and call that 9 to 12 months. What I'm really, for example, if for the position that we put on last week in our paper count, I actually used a September expiration. And the reason for that is I like the expirations on quarterly. That's just my own position. Even though I don't use the quarterly options, I use the monthlies. I just pick that month that the quarter expires in. So if I'm creating a new position, I'm looking 9 months out, maybe a couple months longer than that. If I have too many positions that are already expiring at that 9-month period, that's especially when I won't mind going out and looking for maybe going out for the 12-month time frame. Again, here is where I'm looking to, I mentioned in the previous slide, I like to diversify across different strike prices. In this slide, what I'm really describing is I like to diversify across different expiration months. So I've got a whole bunch of, again, even with the basic diversification of this by itself, I'm also looking to do across time and price. Now, if I'm rolling a synthetic, I like to pick an expiration month that is about 9 months out from its current expiration price. For example, if I had a synthetic that was about to expire in January, I would look to roll that one out, to September. 6 months out, if necessary, 12 months out. I've got a little bit of flexibility there. The main reason I allow myself that flexibility again is the same thing. I want to diversify across different time frames. I don't want to end up with a whole bunch of my positions expiring all in the same month. The more level I can keep that going out 3, 6, 9, even 12 months, the happier I am about that. Excuse me. And lastly, the expiration, I mentioned short synthetics that we use for protection. When I put those on, I'll put them on at a price that I can get for little or no cost. The expiration month that I'm looking at when I put those on is the one that will leave my short positions hedged. So if I have, my short positions hedged. As a long synthetic includes a bullish call or a long call and a bullish put, which is a short put. So that short put is what needs to get hedged. And so if I'm looking at an expiration of, if I've got a long synthetic that expires in June, then I need to put on my protective position to also expire in June. And that way it will hedge the put side, and the short synthetic also includes a long put and a short call, like we talked about at a previous meeting. That short call also will be hedged by the existing long call position in that from the synthetic that I'm protecting. So I'll look to put those on for the month that they expire. And again, I'm looking to put those on regardless what the month is, for whatever price I can get or put the protection on for roughly free. So if I'm hedging a June 190 strike and the S&P is at 205, then the protective position that I put on, the short synthetic I put on, will probably be right around 205 with June expiration. That's like a $15 gap. If I sell it lower, I would obviously pull in some income for that, but that's not the goal. I'm just looking, when I put those hedges on, I'm just looking to do that. Okay. So we've got our ticker, we've got our month, and we've got our strike price. So where do we go from there? Well, the next phase is really how do we manage these positions. In a lot of cases, discretion is going to come into play, and that's because there is no hard and fast rule that will always work forever. And if anyone ever tells you that this rule works 100% of the time forever and ever, amen, they're wrong. So when I say discretion comes into play, it should always come into play, but that discretion is going to be built around the rules that I'm going to talk about right now, or guidelines, or however you want to put it. So what I did is I tried to put together basically a kind of a flow chart and describe how this works out to a daily routine for me. There's a couple ways. That we can be positioned. We can have our basic trades in place with no protection on them. We can have our trades in place with fully protected, and then there's a transition type period where we can have our bullish positions in place, and we're in the process of adding protection. So I'm going to start with, at the end of the day, if we have no protective positions in place, what do we do? Well, the very first thing I'll do at the end of the day is I'll look at our MACD, which is moving average, convergence, and divergence, and the ratio I use is 10/31 of an exponential moving average. And what that means is my short time frame is a 10-day EMA. My long time frame is a 30-day EMA. So that's the two moving averages that I'm looking at. And the time frame that I'm wanting to compare is just 1 day, or one bar, if you will, which means at any one time when I look at it, what is it right now? So it's really, really simple and straightforward. If that MACD is trending up, I'm pretty much done. That tells me that the market is moving in the direction that I expect it to, and I really don't have anything else to do. Like I said before, the 1030 MACD that I use really just kind of smooths out the market, makes it a little bit easier. So if things start looking choppy on the price side, I can look at the MACD and say, okay, yeah, it's choppy, but here's what the direction is telling me. So in that case, I basically looked at the chart for about a second, and I'm done for the day. Now, if I look at it and it is not trending up, I'm starting to see it roll over. Well, the next thing I'll do is I'll look at some thresholds, and these thresholds I'm going to cover at the very end of the meeting. And what they are is they're lines that I've drawn on the MACD chart, and I'm looking for it to cross one of those levels. If one of those levels have not been crossed, so even though it's pulled back, it's starting to roll downwards. If it hasn't crossed one of those levels, I'm still done. I don't need to do anything. If it has crossed, well, then that's going to be my signal that I'm going to need to start looking at legging into some protective positions. But overall, my end of the day routine, if I've got no protective positions on, really is that quick. I can pretty much look at the chart, make my decisions, and move on from there. A couple of other things that I do look at if I have no protective positions on, I'll look at the short put side of any of my open synthetics. If any of the deltas on those short puts has fallen below 15, then that's a signal to me that it's time to roll that synthetic forward in time and take some profits off the table. Recently, we had in our paper account a 185 strike that expired in March that we rolled forward to, I think we only rolled that one forward 6 months. We rolled that to September. And what we ended up doing in the process is taking about $1,000 off of the table in profits, and just and basically just keeping our deltas the same. So that's the first thing I look at. Another thing I'll look at, and this has not happened yet, but in my back testing, I found that it could very well happen. So it's one of the things that I always have in the back of my mind, and that is if I have any synthetic positions due to expire this month. Now, that will pretty much happen around the first of the month, the second of the month, sometime right in the very beginning. If the answer to that question is ever yes, then I'm going to look to roll that position forward. I may roll it forward in time as well as up in price, but it will definitely go forward in time. And then the last thing I look at is, has my option buying power grown enough to allow me to add another synthetic while maintaining 10% of my net liquidating value available for future orders? If it is, I'll add another synthetic to the inventory. Now, what does that mean? I'm going to use some gross numbers here, but if my synthetic position, I'm sorry, if my total account is $30,000, then what I want to do before I can put on my next synthetic is I want to be able to put that synthetic on, and that will obviously use up, that will require a maintenance, a margin level for maintenance. So I need to have $3,000 left over. 30,000, 10%, 3,000. Then that means, so if the SPY was at, I'll use easy numbers, 200, that means another synthetic would require roughly $5,000 in for a maintenance requirement. So that means my option buying power needs to grow to about $8,000. So that would allow me to tie up another $5,000 in my margin requirement and still have $3,000 left over afterwards. Okay, if you have any questions about that, please send me a message and I'll try to explain that better at our next session. But it's not meant to be confusing. If I'm saying that badly, I apologize. But it's really kind of straightforward. Now, there's another time that we'll be looking at this strategy where we'll be sitting in this strategy where we are fully covered, meaning we've effectively protected all of our positions. Our account is pretty much delta neutral, which means for every long synthetic that we have in play, we also have a short synthetic in play. So what do I do when I'm at that position? Well, let's see. If first thing I do again is I'll look at that 1030 MACD, and if it is trending down, I'm done. That just tells me that, okay, it's still coming down. The protection that I put in place is doing its job. I'm not ready to take that protection off. That's it. I'm done for the day. But if it starts to trend up, then I'm going to look at these thresholds again. Now, the same thresholds I have in my chart are the ones that I always have in my chart. And these are the levels that I look for a cross. If it started trending up and it's crossing back upwards through one of these thresholds, or if it's not crossing through one of those thresholds, even if it's starting to trend up a little bit, I'm still done. I'm going to wait a little bit, make sure that we're actually seeing a bullish move. But if it does cross one of those thresholds, that's the signal I'm going to use to say, all right, now it's time to start legging out of those positions, or legging out of my protective positions. So again, about 2 seconds time, I've looked at the chart and I've recognized which path I need to take, whether it's do nothing more for the day or spend a little bit more time afterwards and figure out how I'm going to begin legging in or legging out of those protected positions. Okay, a couple other things I look at when I also look at when I'm fully covered. That is, at the end of the week, I'll look at my 1040 weekly EMA. That's the exponential moving average. I'm looking for a bearish crossover. If that bearish crossover happens, that's a signal that I'm going to use to start legging out of my bullish synthetics. I will leave my bearish synthetics in play because that's happening because the market is continuing to fall, which means the value of those bearish synthetics are going up. I'm just going to start, when I get that signal, I'm going to start legging out of those bullish synthetics. Now, the reason I leg out or leg in for all of these is because just because one signal hits doesn't mean it's going to follow through. I know when these signals hit, it's very likely to follow through, but it's never 100%. It's never 100% of the time. So for me, legging out is the method that I use. I know others that they say, okay, they'll wait 2 weeks, 3 weeks, and that's fine. Everybody's got their own method they're most comfortable with. For me, as soon as it happens, at the end of the week, that's when I'll start legging out. And similarly, I'll look at any of my synthetic positions that are due to expire this month, just like I did before. If they are, then I'll look to roll them forward in time. So let's talk a little bit about that transition period, the short synthetics for protection. First of all, let's understand why we put on a short synthetic position. Normally, we're trading this strategy from a bullish perspective, and that's the way I'm looking at it from here. If we're in a bear market, we basically flip everything upside down, and we'd be using long synthetic positions as protection. But generally speaking, the market is bullish, so that's the way I'm going to that's the perspective we want to look at it from. So purchasing protection. Remember that this is viewed as insurance against a larger pullback. It's not intended for extra income. For example, if you sell covered calls against stock for income, that's great. That's not what we use these protected positions for, at least in the strategy as we do it in our group. Strictly for insurance, mainly insurance for a larger pullback. Again, the strike price that I select is one that's free or very low cost, just like I'd mentioned before. The month selected aligns to the expiration of our long synthetic. And we leg into these. When I say we leg into them, what we do is we'll add these protected positions slowly, roughly a third of our need to get to fully protected about every 2 or 3 days. So one day, if we have 6 long synthetics in play, then the first time that we get a signal to put on a protective position, we would do 2 short synthetics. Then we'll wait a couple, 3 days and see what the market's doing. And if the market's still pulling back, we put on another 2. Wait and see what the market's doing. Wait another couple, 3 days. If it's still pulling back, put on another 2. And at that point, we'd be fully protected. We'd be back to the other method. So, and then we talked about the signals used. I'm going to show that after I go through these notes here. I'm going to show you what the charts look like that we use. In the quick view, this is though is a 10-year view of what those levels are. This is actually 10 years of the MACD. Let's see if I can get this here. This is the MACD 1031. If you look at my cursor here, and these are just the numbers that show up as you move your cursor. This is a printout of it. This goes back 10 years, and it shows how the 2 moving averages, the distance between them varies over time. This is pretty easy. What I've done is I've gone through and I've drawn these lines. This dotted red line is the zero line, and Profit Charts automatically draws that one. I've drawn a couple others just because I seem to see a lot of attention, if you will, at those levels. So I drew one at 75 cents, and you can see you see some hesitation up and down around the 75-cent line. I've drawn one at $2, and I've drawn one at $3.20. The one at $3.20, we've only touched or gone through 1, 2, 3, 4 times, and of course now we're above it as well. So the higher up, the further away you get from the zero line, the less likely you are to. It's not going to get much further apart than that. So, and then on the downside, I did exactly the same thing. I've got one here at negative 125, negative 250, 475, 7, 950, and negative 11. This one here at negative 11, this was back in the 2008 time frame. Is when the market pulled back about 50%. And that's how far separated those two guys got. I don't think I saw, even when I went back further, I don't think I ever saw it get much below that point. So as I use these are the thresholds that I'm talking about when I'm looking for it moving upwards or downwards. It's those thresholds that I'm looking at. Now, sometimes I can also draw lines on this chart. For example, I may decide at some point to draw a diagonal line coming down this way because I want another confirmation of an upward trend being broken. But the basic part is just those levels shown right there. So let's go back to, like I said, when I remove the protection, I leg out the same way I leg in, about 1/3 of them every 2 or 3 days, and it's legging out. Again, I'm using those same thresholds. Okay, this is one other thing I wanted to mention. When the market turns, the market is eventually going to turn bearish. I'm defining a bear market the way most people do, which is a 20% pullback, 20% or more. That's not unusual. It happens. It's part of the normal cycle. When it is in that pullback, though, you don't necessarily want to be relying on your long positions to make money for you. It's not you don't necessarily, you absolutely don't. So when the market turns bearish, that's when I'll get that 1040 crossover signal. I will have these protective positions already in place. Now, the reason for that is the 1030 daily crossover always happens before the 1040 weekly crossover happens. So if I have these in place and the market turns bearish, I mentioned I'll start taking my bullish positions off. Start pulling those bullish positions off. Well, what that's doing is that's effectively making my portfolio delta negative, which means I'm profiting on the downward direction. Okay, so I'm still using the same lines that I've drawn on the MACD. As we saw in that picture on the previous page, they work on the downside and the upside, even through the bear market. They have a different meaning at that point. So, the strategy doesn't change. It's just the investment vehicle that changes from being a bullish synthetic to a bearish synthetic. And the protective position on a bearish synthetic is a bullish synthetic. Again, just looking to neutralize delta when I put on protection. And really, that's the meat of the strategy. Now, what I want to do is I want to show. This is the SPY today. Today's actually November 21st. I guess there was good news that came out of China, or Draghi, I think, also said something. And foreign markets were really excited, but the U.S. markets have been kind of falling all day, which is okay. It's still up nicely. SPY's up about $1 right now. But here's what I wanted to show you. This is pretty much how my chart looks. I use these levels to show where we have our synthetic positions on in our group's paper account. I have a couple lines that show trends. This is a longer term channel. I think this goes back to about late 2012. Let's go back to the 1-year view. And I have a Fibonacci retracement on here. These I'll put on and take off as necessary just to get a different view of what I'm expecting the market to reach for or reach through. And this is mainly what I look at from the price side. Just a couple of basic things that show me what my positions are, these, and what the trend looks like. And then down here is the MACD. Now you can see here it's MACD 1031, just like we described before. And it's these thresholds here. Now let's walk through how putting on the synthetic or the bearish synthetic would work when I go to put on protection. So let's assume I have no protection on back here in December. Okay, the market continues to go up, goes up. Finally, around here, around this time frame, right here, it falls below the $2 level. So that's when I'm going to put on protection. And again, remember, if you follow that flow chart, what I'm looking for is the direction of the MACD to change. So I'll start legging into that protection here over the course of about 6 to 9 days, I would be fully covered, which means my account delta would effectively be 0. And I'd see the market pull back. The MACD would continue to fall. It comes down below this 125 level, finally starts to bounce up, comes through here, and then this is where I get a signal to start taking that protection off. So I put protection on in this area right around 180 to 182, and I get my first signal to start taking it off when the high of the day is around 179-ish, 180, somewhere around there. And I'm going to spend the next 6 to 9 days taking protection off. Some of those protected positions are going to end up costing money. That's okay. What I'm really protecting myself against is the bigger pullback. For example, this period here, this was about a 7.5% pullback. Most of those protected positions were profitable. Just like here, this was about a 5% pullback. Most of them were profitable, but not all of them. Some of them ended up costing me money. That's okay. When the bearish position is costing me money, I know my bullish position is making money to compensate for that. So it's not that I'm losing money so much as I'm not making as much profit as I could otherwise. Now, where I will say that when this gets more difficult is when you go through a period of relative flatness, and this period right here is probably a good example of that. You can see here we would have had a signal to put on protection. Here, if we got a little overzealous, we might have said, yeah, that's close enough. It's bouncing up off the line. It didn't actually go through it, but it bounced off it. So I'm going to take off position or take off protection. Comes up and then finally falls through it. It's easy to allow yourself to get whipsawed back and forth. So you have to be willing to either recognize that or find something to keep that from happening to you. For example, you may have a rule that says, if I bust through one line and I don't get a clear fall through another, I'm just going to keep that protection on a little bit longer. And that's fine. It's whatever's going to work for you. I do recommend back testing whatever method that you come up with, though. For me, my comfort level was, generally speaking, recognizing that I'm going to get whipsawed, recognizing that it's just going to piss me off when it happens. But overall, in the bigger term view, this is an investment strategy, not a trading strategy. So in the bigger picture view, it was overall still more profitable for me to kind of stick with the rules that I have put together there. So that's it. I tried to keep this one relatively short. We're at about the 38-minute mark. So I'm going to wrap things up. If you have any questions, please feel free, post in the community. You can respond to blog posts that you might have linked to this from. Any way you want to get in touch with me is fine. I'll be more than happy to answer any questions or elaborate on anything at our next meeting. So thanks for your time. I wish everyone the best. Enjoy the rest of your weekend, and we'll see you next time. Cheers, everyone.